Joel, thank you so much. And thanks everybody for being a part of this incredible conference. I can't imagine a conference that's more ripped from the headlines without the doink doink than this conference. It's so timely. I'll give you a couple of quick statistics. I teach investment management and impact investing, which is broadly construed to spend a lot of time on ESG. And this last year, I had more students in impact investing than investing, which tells you a lot about preferences and interest. And a lot of our students are going into the sell side, but many are now going into the buy side again. The buy side's back. Thank you again, Olivia and Steve and your team. We had a bunch of stuff going into this, including COVID, and your patience is really much appreciated. I'm going to maybe spend 2 minutes talking a bit about a conceptual way of thinking about ESG, and I think a lot of this has already been touched upon. But we've now taught something like 1,700 MBA and other students, undergraduate and other students, executives, about ESG in our main programs, and of course many others elsewhere. And there's all this kind of ongoing question, in part induced by the question of fiduciary responsibility, about how to think about it. And here's what I've come down to in talking to literally thousands of people about ESG and impact and those considerations. I'm going to give you what is a classical utility function. Economists sort of don't necessarily like this utility function, but if you maximize this utility function for a given level of required return by minimizing standard deviation, leaving impact out of it, that gives you maximal Sharpe ratio portfolios. This is called mean variance utility. Economists don't like it for all kinds of reasons, but it is still used, in my experience, to generate asset mixes for institutional investors. The Sharpe ratio is an ongoing, maybe it's the most broadly reported statistics in investment management. So what does utility say? It says, well, you like expected return, you dislike standard deviation. It's squared, which is why it's called quadratic. It has to do with curvature. As volatility goes up, you dislike it more. A is a risk aversion parameter that tells you how much you trade off risk versus reward. So it's positive in reward, you like reward, you dislike volatility. And under normal circumstances, without a consideration of anything else, that it tells you what your preferences might be. And again, this is not a derived utility function based on theory. It's a way of understanding as a lens this notion of ESG or impact. More generally, we can assign some kind of utility that someone gets from impact. So the various methodologies and attitudes and understandings about what ESG really is, which I think I'm ultimately going to argue is a way of understanding information that's not reported under traditional GAAP accounting, can influence any of these pieces. Traditionally, the idea would be, by way of socially responsible negative screening, we might gain utility by investing in a manner that's consistent with our values simply by getting rid of whatever you don't like. You don't like tobacco, it's anathema to you on a morals or ethical or whatever basis it is, without making judgments, then that would still improve your utility to screen it out. Of course, it might impact your Sharpe ratio because your investment opportunity set gets smaller. Well, in that case, then there's still a rational reason for being a utility maximizing investor, because you get something else from the impact of the ESG negative element. By the way, this is an obvious point and everyone I'm sure is aware of it, but remember, negative screens are also positive screens. Portfolio weight's always sum to one, so you get rid of something has to come in to replace it, because again, weight's sum to one. This may be fine for individuals. The problem, of course, we all know well, is that from a fiduciary perspective, if we give up on the Sharpe ratio because of impact advances in utility, well, that puts us in a bind, even if investors are after that. And by the way, some of you are aware of a recent article that I think is being published in the Review of Financial Studies, in which some folks did a survey of pension fund investors, something like 80% or just below 80% of which actually pursued impact and would be willing to give up some measure of return, holding risk constant. But I think, as ESG and the notion of conscious capitalism and information relevance and availability has continued to evolve, what our speakers so far today have also talked about is that ESG may be information or measurements may represent information useful for understanding expected return or risk. In other words, it may be the case that because of regulation FD or again, limited information provided by gap disclosures, ESG may provide additional information, and of course, perhaps in what we might call the public domain, or in some cases, proprietary domains, that would allow us to understand expected return and volatilities more. When we talk to asset managers and we do surveys and so on, we hear them mentioning all of these. And in particular, this is from the most recent SIF's Trends report, have been focusing on risk and reward. In fact, the #1 most quoted notion for referencing ESG elements in the recent SIF survey of institutions is risk. And it's not just impact or the social aspect of it. And we have seen how this has evolved. You can look at all kinds of fiduciary guidance and rules and concepts across the board. But yeah, I think we all know what 94 led to in 98 when Robert Doyle, in guidance from the DOL, described SRI investments. He said, expect a return on alternative investments, here not hedge funds, expect a return on also possible investments with similar risk available to the plan. That's essentially the Sharpe ratio. It induced a side-by-side comparison idea between ESG and non-ESG, if you will, or what is in the portfolio and might be out of the portfolio if you're otherwise to screen it, that said, okay, that sounds good. Well, that underwent a series of gyrations over time. Thomas Perez, under the Obama administration, described how it may be possible to think about impact or ESG or SRI investing. And of course, we know under the most recent regime, it got rolled back a bit with a very, very strong attention on process and purpose. Now, I'm presenting a new paper, not an old paper, but we did write on this a decade and a half ago. This is with Rob Stamba and David Levin, who was working for Kofi Annan at the time. This is now being reissued in the Review of Asset Pricing Studies. Without belaboring and torching you for what all these different statistics are, just to say it really quickly, these are factor loadings or betas or risk exposures to proposed factors or presumed factors. MOM is momentum. These are standard for academics. SMB is the small stock spread or style spread between small and big. HML is high versus low book to market. It's a value spread, and this is the market premium. These are all essentially beta exposures. Delta is what many of us would call alpha. Why not alpha? Academics invent new statistics. That's how you get famous. Didn't quite work, but delta is a new notion of excess performance. This contrasts a little bit with what Veet discussed a little bit in the last session. What we find, if we look at SRI and non-SRI mutual funds, this is again over a period of a couple of decades, we actually find that screening funds generated higher alpha, but it was it required our notion of adjusting for risk. So what do we do in this paper? We redress this notion now at the security level of whether ESG statistics and characteristics are correlated with expected returns. This is not the first time this has been written about. In fact, another forthcoming paper, I think at the GFE, looked at carbon risk as a risk factor and found that it priced securities. We're going to find something a little bit similar when we look at environmental concerns, because that's where we see so much interest today. The reason we think this provides additional value, not just in the general literature, but above some recent research we published, is that it specifically uses models that have been in the literature since 1993. And of course, the issue in academics is that we tend to data mine the data. We all sort of have one big data set, although new data sets are great, as Veet also said. And there are questions about whether that really applies going backward in time in our research. So these are models that were developed by my co-author, John Gerard and Harry Markowitz, of the famous Markowitz, Nobel Prize winner, and colleagues over the years across multiple papers. And so we're specifying 4 different models that have been out there for a long time. One is called USER. That stands for US Expected Return Model. It's an encompassing model that uses we're using and then using subsets. These are in the slides that you can look at. I'm going to point out maybe two things. Number one, we have two primary tables. One, when we look across the models, they produce expected return spreads that you can see highlighted. The user model generates an alpha against multiple models today of around 300 basis points. Then, when we interact it with ESG characteristics, specifically now focusing on environmental characteristics, in part because that seems to be the most prominent reference today, we continue to see alpha spreads that are both apparent for the expected return model, but then an additional amount of alpha related to environmental risk or environmental spreads. To see it, you can see the bottom line. This is kind of I could have showed you one line for my whole presentation, which is that once we look at high environmental normalized scores for KLD, and this is from MSCI, and high user scoring, and you compare it to low, that's the bottom line here. You can see at the bottom line, look at the spread. There's an additional amount of alpha contained. So it looks like it's above and beyond just the traditional factor model. A bunch of detail here. It interacts with quality. It interacts with profitability and so on. At the end of the day, what we think is that long-standing models, which are the right ones to use, not the new data mined models, interact with ESG characteristics that may not require you to lose. And we think that's probably the trend in a world where information is limited and expensive to understand. This is a way of understanding non-GAAP, non-accounting oriented information about firms. And so it's a rephrasing of the entire question of side-by-side comparisons and even Sharpe ratio reductions into value adds and understanding of the way companies work.